Hello and good morning. Hello and good morning. As always, appreciate the opportunity. Big thanks to the Cotton Board for pulling this together. Somebody please give me a shout if you're not seeing the presentation here, but hopefully everything is working all right.
Looks
So
great.
once again, I'm Jon Devine, and this is your cotton market update. As a cotton market update, I think it's always appropriate to begin with a price slide. So here is a price slide. We've got history here on our December or new crop futures going back to um, the start of the 24-25 season. And I think as many of you are familiar with, we haven't had a lot of movement in the cotton price here over the past many months. If we go all the way back to the start of their calendar year in January of 25, we've seen December prices really only move in this tight range between 66 cents more or less and up to around 70, 71 cents more or less. So not a lot of movement in cotton prices, but we certainly have had a lot of movement out there in terms of macro developments and also developments specific to the cotton market as well. And throughout this presentation, we'll discuss those and also discuss some of the reasons why we maybe haven't seen more movement in cotton prices, given all that change that has occurred out there. But to get some perspective on the current market, I think we need to bring in a little bit more history. So here we're zooming out, going all the way back to the start of 2016. So we've got roughly 10 years of price history up on here. We've still got that recent range highlighted with those two bars. But I think to understand where we are right now, we need to understand where we've come from. And we can start by taking a look at, what stands out in this chart. And of course, that is the recent peaks that we had. We did have prices get up to 150 cents per pound as we came out of COVID. Then more recently, we had another peak around 100 cents per pound that we set around the start of the 24 calendar year. So we take a look at where we are right now. Of course, we are a little bit lower than where we've been, and certainly lower than where we've been on those peaks. But for understanding where we are, I think we need to talk about some of the factors that have brought us those peaks and also led to some of the decreases that we've experienced coming off of those peaks. So we're zoom in a little bit and just take a look at factors that contribute to that really strong growth that we had in prices as we came out of COVID. So, no surprise with COVID, there's a lot of concern about not only human health around the world, but of course economic health around the world. We can see the impact that had on global mill use with it dropping down to only 105 million bales in the 2019-2020 crop year, which is when we had COVID. But something I want to highlight too is what happened when we came out. So when we were coming out of COVID, of course, there was a lot of stimulus in the face of this unprecedented health threat. There was unprecedented stimulus around the world, and consumers came back a lot quicker than probably could have been expected. And that's particularly true in the US. And that contributed to rocket ship up in terms of global mill demand from 105 million bales up to what was a record amount, or what is a record amount of 124, getting close to 125 million bales that we had in 2021. So, point of bringing this up is just to highlight, where we've been on the demand side of the market and how demand has affected prices. When we had that surge in demand a couple years back coming out of COVID, when we hit those record volumes for mill use, we did hit that recent high in terms of the cotton market. Of course, with stimulus fading and some of the concerns shifting from COVID to inflation and higher interest rates and the potential for recession, we had a big whiplash hit the market. So we went from record cotton consumption down to some lower levels as we moved into 2021 and the years that have followed. That brought prices lower. We were able to hang on to that shelf there between generally 75 and 90 cents per pound for a year and a half, 2 years. Then we broke out to the top there with our recent peak, and then of course we've shifted lower here too. So just trying to highlight macro factors that have affected the market. Stimulus and COVID coming out of COVID helped pull us a lot higher. We were able to hang on a little bit after that, but of course we're suffering some of the hangover effects from that here more recently. We take a look at this more recent price spike or the price peak that we had back in early 2024. It's not macro forces that really contributed to that. It was some cotton specific market forces that contributed to that. This is one of those you don't need an economist type slide to point out what contributed to that price surge that we had back in 23, 24. But of course, it was driven by the strength of demand coming out of China. China traditionally is the world's largest cotton importer, but as this chart points out, there can be a lot of volatility in terms of how much cotton China is bringing in. And what can make things a little bit more difficult in the cotton market is that volatility is driven a lot by government policy in China. That was the case back in 23, 24. During 23, 24, there was some concern in China about the health of their domestic crop. There was some speculation in that market or concerns about speculation in that market. And the government helped tamp down on that by releasing from its reserve stocks. So if you're not familiar with China, they have reserve supplies, somewhat similar to our strategic oil supplies we have in the US. When prices can get high for certain commodities, they can release their strategic supplies. And they did that back then. But the story here is not so much on the release of supplies they had, it was on the buying that they had to help replenish after they made those sales. When China went to replenish what it sold back in the 23-24 season, they went exclusively to the international market, and that helped drive that big increase in Chinese imports we had a couple crop years ago. This volume was the highest imports we had in China going back for more than a decade. So that was a factor that really helped push prices higher. Also, during this crop year, we had issues with abandonment here at home. The tightness in U.S. exportable supply helped bring prices up to levels touching $1 there briefly, going back to early 2024. But since then, we have seen prices move lower, and one reason for that is we have seen what can be the world's largest buyer of cotton pull out of the market. So from 15 million bales, China brought in just a little bit more than 5 million bales last crop year, and they're expected to only bring in about 5 million bales this crop year too. So after some really strong demand, China built up its reserves, and that reserve supply still hanging over the market as well, probably going to help hold Chinese imports down even as we go out maybe another crop year or two. So that's one big influence on prices. Another big influence, of course, is what's happening on the exportable supply front. So not only did China pull back from the market, but we take a look at major exporters out there. Of course, we've got a lot of competition from Brazil. They continue to produce record crops, meaning they have more and more cotton to sell on the export market. In addition to China pulling back, we've got increased competition coming from Brazil. Of course, we've got our crop on top of Brazil. We can add in Australia. We can add in West Africa. These are all of our major sources of exportable cotton around the world. And in addition to China pulling back on the import buying last crop year, we actually had a record volume of cotton available from these major cotton shippers. And of course, when you do have more exportable cotton, that can create more competition, and that additional competition can weigh on prices. And that has been a factor that has helped push us down into that trading range where we've been at for the past many months. In the 25-26 crop year, similar story I think is expected to continue. Once again, China expected to hold imports down, and we still do have ample exportable supply out there. So continued competition on the export front, continuing to be a weight on the market. But I do want to highlight some other data here too. Just take a look at the pullback in China. This has affected all exporters. So we talked about new exportable supply maybe coming on from locations like Brazil, but even Brazil, got hit really hard by the pullback in China. Their shipments to China down more than 60% year over year. We're down a little bit more proportionally. I think, geopolitical events and, some of the tariffs that China has put on our cotton shipments, potentially a factor there, slowing us down relative to the rest of the world. You want to take a look at some other competitors out there. Australia down, but down by smaller margins. They're picking up some market share in that smaller Chinese market, but other markets, including what would generally be West Africa and some Central Asia, down proportionally to what we're seeing from China across the board. But the point is, when you have your biggest buyer pull back, it's going to affect essentially all of our sellers, and these big changes we're seeing from our export markets are certainly reflective of that. So that's been a factor that has helped push the market lower. But when we're talking about these prices, we take a look at where we've been over the past couple of months. We've been range bound, and that means we have some support from underneath as well. Now, bear with me a minute. I want to walk you through what can be a little bit of a technical discussion regarding how we do have some support actually coming in potentially from the speculative side of the market. So here we got our futures prices. We've got about 10 years of price data on here. To it, I'm adding the net position held by speculators. If you do take a look at this blue area that's positive in terms of the values on the right axis there, that's indicating that specs are betting prices will increase. So it's the amount of their long bets minus their short bets. And you can see over time they tend to be more net long than net short. But here more recently, if you take a look at where that blue area has been, it has been pretty net negative. And if I was to extend this chart all the way back through its whole history, which extends back to the mid 2000s, where we've been here over the past few months is actually the biggest net short positions that specs have held on record going all the way back. So what does that mean for the market? It does mean that we did see specs potentially push prices a little bit lower going back into the summer of 2024 as they started adding to their net short positions. But also, I think there's a little bit of a silver lining there too. When we run the numbers on these, and when we take a look at the factors that really affect prices relative to spec positions, it's a change relationship, not a holding relationship. So when specs change from being net long to net short, or when they move their positions around either on a net long or net short side, it's that change that they have in the futures market that drives the change in prices. But if they're having a really net short position and they're not changing it, that's not really affecting prices, and that's something that was maybe helped us keep in this range is that they're not adding further to their short position. Something else we can take a look at here is just what may be driving specs position. Of course, they place their bets for a reason. And if we take a look at where they've been recently, I think the trade dispute or potential for trade dispute could have been a factor that helped increase their short position. And that's, given the fact that when we take a look at the previous record they had for net shorts was back in trade dispute round one. So specs have been net negative. I think they're looking at what's going on in the trade environment. But the silver lining here is that if specs are already extremely short, we don't want to tempt them. But how much further can they go? What is the more likely position? Are they going to add to their short position, or may they start easing off that? And I think the fact that they haven't been adding to their short position is something that has put a little bit of support under the market and kept us from moving lower than we have. Something else that may be lending a little bit of support is some sales that we've had from markets outside of China. So what I've got here is import numbers for China. So the same chart we had before. The gray area I'm stacking on top of it is just showing imports from locations outside China. And if you take a look at those numbers, we have seen some really big changes over the past couple of crop years. Back in the 23-24 season, you can see that imports from the world outside of China were pretty low, down at less than 30 million bales, which is the least amount of cotton that that collection of countries had imported going back for more than a decade. We did have something that we've been calling a textiles recession that occurred around that time period as we transitioned from this period with stimulus out there in the market to one where there's concern about inflation in interest rates and the potential for recession. There was a big pullback in orders. There was a pullback to draw down on inventories instead of putting new orders through the pipeline. And that's showing up in some of this weakness that we have in import demand for countries outside China. They're dependent on downstream orders and don't have government system like China buying up reserves like they did back in the 23-24 crop year. But once again, the good news there is that we are seeing these other markets come back. And if you do take a look at the import volumes that are forecast for countries outside of China in the current crop year, it's expected to be the strongest volume that we have actually on record. So some strong growth out there. We're selling a lot more cotton to Pakistan. They've had issues with their domestic crop, some issues with getting cotton produced out there, and that's helped our sales and also the world sales to Pakistan. India is starting to transition from being a net exporter of cotton to being a net importer of cotton, and their imports are up more than 2 million bales just over the past couple of years. Vietnam rebounded with some of this improvement in a downstream order placement environment, increasing its imports 1.5 million bales. Turkey also improving. Egypt is a location that has seen some investment. We are seeing some more spending moving into Egypt, and we're seeing them maybe looking at importing more cotton down the road. And then Bangladesh also coming back. Bangladesh expected to be the world's largest cotton importer this year. So China pulling back, but there are other markets that are opening up a little bit more, and that their market situation has improved relative to where they've been over the past couple of years. This is something that's true in terms of cotton they're getting from all locations, but it's certainly true in terms of cotton they're getting from the U.S. Here's data for the 24-25 crop year. Of course, just winding down over the past month or so. Sales or shipments to Vietnam last year up over 130%, so a big rebound. Pakistan up 80%, Turkey 100%, India over 200%. Latin America, was a really good market for us, up about 20%. So really strong sales for these markets outside of China, helping to offset some of the decreases we had in China, but really flat year over year in terms of our export shipments. Strong growth. We're happy to see that recovery out there, but the recovery not quite enough to help compensate for all the losses that we've had in China last crop year. And I think as we look ahead in the current crop year, probably similar situation in terms of our sales pattern could potentially hold. So with that, we're transitioning ahead and take a look at, our crop situation, how we might sell our crop in this 25, 26 crop year. In terms of our crop numbers, there have been some really big changes over the past couple months. And one of the big changes that we've had has been just even in our acres planted numbers. Um, so you take a look at these figures, of course, been a big evolution in terms of the outlook for cotton planting for this current crop year. If you go back early, so projections at the end of the 2024, looking ahead to the 25-26 season, initial expectations were maybe indicating acres could be flat. But then we started to see the council's number come in February, USDA's numbers in March and June, a good bit lower than when those initial expectations were. And then in August, we had another big revision with acreage dropping almost 800,000 acres relative to where we were just in June. So this is pretty late into the season, not really getting dialed in terms of our acres planted numbers until just a month or so ago. Big decrease in planted acres this year. Of course, profitability is a major concern for everyone in the industry. Helping offset some of the effects of lower acreage in terms of U.S. production is the fact that the weather's been a little bit better. Here we've got condition ratings. This is the share of the crop rated good or excellent. That dark line is showing you current season, and you compare that with lighter lines going back deeper into history. And you can see over the longer term, the trend has been as the season goes on, we tend to see condition ratings get lower, and we can see production forecasts potentially move a little bit lower. But this crop year, we've seen an opposite pattern with condition ratings actually getting stronger than holding on even as we get through those critical months in July and August. And of course, what's driving that nationally is the condition improvements that we've had in Texas. And in Texas, you can see that condition ratings holding up in July and August, which is different than what we've seen in recent years. And all that affects, the abandonment rate. Taking a look at abandonment rates this year, expected to be a lot better than what we've had over the past 3 years, but still not all the way down to what we consider a really strong, really good year in terms of abandonment, with abandonment expectations out there in Texas expected to be around 30% this year. But everything put together, current forecast for production at 13 million bales and some change, to down roughly a million bales relative to where we were last year, but up a little bit considering relative to where we were in 23, 24 when we had that tightness, which contributed to that last price peak that we had. So putting things together from supply side, demand side, we want to put production relative to U.S. demand. U.S. demand is domestic mill use, which is dark blue, plus our exports, which is light blue. Total demand up there over 14 million bales. So if you do the math, compare demand to our incoming crop, we are expected to have a shortfall this year, which will bring down our stocks and can be friendly for prices. But we did build up our stocks last crop year, and really we're just unwinding what we did last crop year. So we're not getting all the way to tight conditions, but we are helping get rid of some of the excess that was accumulated in the 24-25 season. And with all that, there are some questions, and I think, the big question for us, given where we sell most of our cotton, and that is to the international market, is how strong are export sales going to be, and in particular, how strong are export sales going to be to these markets outside of China, because I think we probably will continue to face some challenges from the Chinese market, not only because they pulled back in terms of their imports relative to where they've been a couple years ago, but also because we are facing some tariff disadvantage relative to some of our competitors over there right now. But there's also some tailwinds that could continue to support our sales for these markets that are tied more closely to downstream demand. And one of those has to do with some of this inventory adjustment. So one of the reasons why I've been including some history in this discussion and going back to discussion about COVID and stimulus and all that, is that there are some factors or some ripple effects from those major events which are continuing to affect order placement throughout the cotton supply chain. And to help demonstrate that, we've got this chart. We got two lines on there. The green line is showing you consumer spending on apparel in the U.S., It is adjusted for inflation, so it's a rough measure for the volume of apparel being sold. And then the dark blue line I've got in there is a rolling average of apparel import volumes. And something that we've been looking at really closely over the past couple of years, and this is a chart that Barry would always include in his discussions around de minimis, was that we've had this really big gap. So you take a look at consumer spending in the U.S. on apparel. We surged up with stimulus in 21. We've been holding on to those gains since then, but we did see imports really pull back sharply as concerns about inflation started to mount. A couple reasons could explain that gap. Already mentioned de minimis and some of the discussion that we've been having around that in recent years. But another factor is inventory rebalancing. So as we came out of COVID and consumers were spending their money, retailers and brands were really trying to get a product in front of consumers while they were spending on apparel that costs a little bit more money than it used to. And that helped drive a lot of orders through the supply chain, helped us drive that record mill use level that we had back then. But then we had that really quick reversal. And when that reversal being so fast from stimulus fueled euphoria to concerns about inflation and recession, there's a lot of orders still moving through the pipeline. And that created some inventory accumulation. And that contributed to that textiles recession that we've been in here for a while. But we've moved through that textile recession and we've moved through that inventory drawdown period that we had existed for maybe a year or two. And that's exemplified here by this inventory sales ratios. This is the inventory levels at retailers and brands and also clothing wholesalers in the US. You can see the big spike in inventory they had in 22 and 23 as they moved into concerns about inflation. And it's only been over the past several months that they've moved back to levels that were pre-COVID. And the purpose of showing all this is that inventories have been drawn down. They're not going to be able to rely on apparel that's stored in warehouses anymore. There's going to need to be orders coming through the supply chain to keep up with consumer spending, just as long as consumer spending holds up in locations like the U.S. So that's helped pull us out of that textiles recession. That's something that's going to help us, I think, when we look at order placement for countries outside China in terms of the amount of fiber that they're looking to buy. So there is a tailwind out there in terms of some import demand or downstream demand that could help the fiber demand and our export sales. But of course, something that could be a potential headwind to us are some changes in terms of the global trade landscape. Still a lot of uncertainty out there relative to what might happen with tariffs, but briefly, just walk you through a timeline of the major announcements that have come out so far. These are focused on announcements relative to China, of course, because China is so key in terms of the global textile industry. So we do take a look at tariffs, and when these announcements started, they started in early February, so not long after new administration came in. We put 10 percentage point tariffs on China immediately. China had a limited response to that February increase. In March, we put another round of 10 percentage point increases on tariffs from China. China did respond. They did put tariffs on U.S. cotton up 15 percentage points relative to where we were previously. So that has put us at a little bit of a disadvantage. And of course, what is a cost competitive market? And then, of course, since then, we had a series of announcements beginning with the reciprocal tariffs being introduced on April 2nd. Did have some escalation, did have some pullback from that escalation as we move later into April and into May for China. More recently, things have gotten solidified a little bit, particularly with the July 31st executive order, which detailed tariff increases for most countries out there. So we did have some baseline shift. We did have 10 percentage point increases on tariffs for most locations outside of China for the past several months. But that was reorganized beginning on July 31st. And I think we are in a new negotiating position right now that probably will hold with us for a while, just as long as we don't see major changes to the tariff system at large, which we'll touch on here in a minute. But just to summarize where we are in terms of tariffs, and there's a lot of details here in this table. If you are interested in this, I mean, you can come back and maybe put on pause in the YouTube video to check out the exact numbers. But what we've gotten here is where we're getting our cotton apparel from. We've got the percentage shares from 24 calendar year in there. And then the other columns you've gotten there are the announced tariff increases at different points in time. The April 2nd announcements were the Liberation Day reciprocal announcements that came out initially. The April 9th numbers are the revised numbers that went lower. And then the July 31st numbers are the ones that are in effect right now. So you can see sort of how things have changed. Once again, a lot of numbers in there, but just walk you through some of the highlights. If you want to take a look at where we are now relative to where we were on April 2nd when things were initially introduced, current tariff rates are all lower or equal to what initially was presented. So there has been a little bit of a pullback. The average rate in terms of increase for major apparel exporters to the U.S. is somewhere around 20 percentage points. So meaningful increase. But negotiations are ongoing and details around any deals still surfacing. So still some potential for change there. Some of these deals that are being introduced around tariff negotiations do include incentives specific for U.S. agriculture. Two examples so far are those related to Indonesia and Japan. And something that may be of interest is that Indonesia deal specifically mentioned buying more U.S. cotton as part of that negotiation. So um, continue to be some wait and see there in terms of details that may continue to surface over time as negotiations continue to unfold. But something else I want to highlight is just how some of these tariff increases are being implemented. A lot of you on the grower side may not be familiar what folks on the importer side may be facing. But here I've just got an example pulled from a cotton dominant t-shirt. Tariffs in apparel traditionally have been one of the higher segments in terms of rates that are being paid for imports. Base rate for a cotton dominant t-shirt before any of the rate increases we had this year was 16.5%. To that, we can add the 20% average that we're having for most of our cotton apparel providers to the U.S. market, which will bring current tariff rate over 36% for most sources. For China, things are a little bit different. Something that hasn't got a lot of attention, but we've had tariff increases on China that have been in place since 2019. So we had a 7.5 percentage point increase on China going back a couple years that has continued to be in place. On top of that, we added three consecutive rounds of 10-point increases, bringing the total for 30-point increase on China so far in 2025. And the duty rate for China over 50% for a cotton t-shirt. But something that may be more interesting is to take a look at the situation on the man-made side or what the competition is in the apparel, in terms of apparel sourcing. And something that's built into our tariff schedule, and this is something that has been in place even before any of the recent additions, is that man-made garments are traditionally tariffed at a rate that is a good bit higher than what we're seeing for cotton. So base rate for cotton dominant t-shirt nearly twice of what it is for cotton. With that 20% addition, it brings the average duty rate for cotton dominant t-shirt from major sources over 50%. And for China, it's approaching 70%. So something we were concerned about when they were talking about reciprocal tariffs is that maybe we'll see some of our rate advantage for cotton disappear, but that is not the case. The cotton's advantage over man-made products from a sourcing cost perspective has been maintained despite all these changes that we have had to tariffs. And something else that may be relevant to that discussion too is where we getting our product from. When we take a look at a pie chart breaking down where we're getting cotton dominant apparel from relative to our man-made dominant apparel and focusing in on China relative to the rest of the world, we can see that the cotton dominant apparel sourcing has been more diversified. Of course, there's been some factors contributing to that, like concerns around forced labor here in recent years. But cotton apparel sourcing has been better positioned if given trade potential for trade dispute with China relative to the man-made side. And when we take a look at changes that have occurred in sourcing here over the past several months and even over the past several years, we are seeing maybe some things a little bit favorable for us here, particularly here more recently. So here in this chart, I've got the bale volume of cotton and apparel coming in from China. On the other side, I've got the amount of man-made fiber coming in from China. And you can see that, with China being so polyester heavy in terms of their production of polyester, we see that market share for cotton is lower than it is for man-made, but with the tariffs, we have seen cotton sourcing from China go down less than we have seen than man-made sourcing from China go down. When we look at some other markets that have been picking up share from China, we see cotton is more prevalent. So in countries in South Asia, which would include India, Pakistan, Bangladesh, we see cotton has a higher market share, the bale volume there on the left, higher than the bale volume on the right. And as these other markets increase their share, that can be something that's favorable for cotton share in the U.S. We take a look at ASEAN, which is South Asian countries also seeing some more cotton there as well. And then in Latin America too, we also see cotton share being a little bit higher. So if we do think about shifting away from China, there are some potential benefits there for cotton consumption, at least in the U.S. market, because markets outside China are less tend to be less associated with polyester. And we have seen that in terms of cotton share too. We've seen cotton share bump up a few percentage points since tariffs have been in place since April due to repositioning around China and potentially due to additional sourcing opportunities for cotton relative to man-made when you take a look at markets outside China. So cotton share movement is favorable, but of course, what we're concerned about is what may be happening in terms of bale volumes. And what I've got there in a chart on the left is the bale volume of cotton and apparel imports. Recently, of course, we're focused in on what has been happening here just over the past few data points since tariffs have been in effect. We did see a bit of a drop there in 1 month, but since then we pulled back up, and we're seeing essentially cotton import volumes over the past couple months have been really in the middle of our longer term range. Things have been falling off a little bit, but not falling off maybe as much as you would expect given some of the size of the tariff increases that have been in place. Of course, this is something we'll continue to watch. A lot of uncertainty about where tariff rates might be, a lot of uncertainty about where the economy may be going, but at least so far, we haven't seen things collapse as much as might potentially have been feared. But a lot of uncertainty out there. In addition to all the uncertainty regarding tariffs and how the supply chain might react, there's also some uncertainty about how tariffs might continue to be in place. There's been a couple legal challenges out there. There are two major court cases that were presented against tariffs. All these were centered on the legal authority that the government may or may not have to implement these tariffs. So if you wind things all the way back, think back to your Schoolhouse Rock days, the official authority granted by the Constitution to manage foreign trade lays with Congress. But over time, Congress has delegated some of that authority to the president, allowing the president to act more quickly when there are times of emergency, such as wars in the past. And if you do hear people talking about the International Emergency Economic Powers Act, or IEPA, this was one way that Congress has delegated some of its trade authority to the president. And this is what the president has used to justify the power to change tariffs. But there are some questions that have been raised in these legal court cases, one of them through the Court of International Trade, which manages trade tariff disputes in the U.S. They indicated back in May that the president maybe doesn't have unlimited authority to change tariffs, maybe has some ability, but not unlimited ability. Then there was a separate case that came out of a district court in D.C. that found that this IEPA did not cover tariffs. If you read the IEPA, there's no mention of tariffs in it anywhere, and that may not be sufficient to allow the president to change tariffs. So both of these cases went immediately to appeal. There was a ruling on that just a few weeks ago. Given that ruling that occurred just a couple of weeks ago, which upheld the initial finding that the president does not have limited authority to change tariffs, this whole tariff issue is going to be headed to the Supreme Court probably sometime in November. Big implications out there because there are questions about refunds. If these tariffs were not legally implemented, are retailers and brands going to be able to get their money back or not? And just imagine how messy of a situation that might be. But even if the Supreme Court does uphold some of these recent rulings, there are other avenues that the administration could pursue to justify increased tariffs. They just may take some more time. They may require some comment periods and may require some research to help enable that justification. So a lot of questions about what the outlook is for tariffs. And that's something, of course, that we'll continue to watch. There's also been some other important updates out there to trade policy. One that we've been paying attention to, of course, over the past couple of years is a de minimis issue. De minimis no longer an option. That's true for China and Hong Kong, but also all countries around the world now. Some other positive developments out there is that in the April announcements relative to tariffs, there was a carve out for U.S. content. So if the content of a good is at least 20% U.S. made by value, that's eligible for a tariff discount. It can be hard to get to that 20% level to qualify when we take a look at fibers value share relative to garment sourcing, but it is something out there to help encourage U.S. sales. Something else that's out there to help encourage U.S. sales is the Buy American Cotton Act. The council has some information out there. You do a quick Google, you can get some more information on that. But some incentives tied to um, buying U.S. cotton, tied to sourcing of U.S. Of apparel coming into the U.S. too. So some drivers that could specifically favor U.S. cotton relative to the rest of the world are out there right now. But all this feeding into our market outlook, we do have this evolving policy tariff situation, of course, very, very complicated, not only in terms of the numbers that are involved, but also the legal situation out there as well. Those questions are going to probably continue to last not only for the next several months, but also for the next several years. That's something that will factor in somewhat to the macroeconomic situation and be something we continue to watch. Also, some concern macroeconomically, taking a look at the job situation here in the U.S. A little bit slower growth than what we've had more recently. So that's something we'll continue to watch too. But beyond that, we do have these stubbornly range-bound prices. From the top down, we've got, exportable supply weighing on limited import demand given China's pullback from the market. Then underneath the market, we also have the fact that specs are already really net short. Now, are they going to be able to go more net short? That maybe could pull us down a few cents per pound, but it does, probably give some support to the idea that the bottom may be close, if not already in the market. But, dominant theme, I think, from supply demand standpoint is the exportable supply still out there, and that's going to probably be something that continues to limit our ability to move significantly higher, at least in the short term. So with that, those are my thoughts on the market. Certainly welcome any comments or questions that you guys might have.